welcome to BloombergQuint. The monetary policy review left the repo rate unchanged. There was no change in the stance, which remains accommodative, no change in the voting pattern of the stance, and no change in the reverse repo rate from the RBI, which some section of economists were hoping or expecting. Now, you would say that if nothing has changed, this will be a short conversation. But when you have two economists who are also very clued in on the money markets, I assure you there will be no short conversation. There's still a lot to discuss. Kaushik Das, Chief Economist at Deutsche Bank for India, is with us. Vivek Kumar of QuantEco Research is with us as well. Thank you both so much for taking the time to speak to us. Kaushik, to you first. We all, me included, said that the policy was very sort of dovish, a little bit more so than we would have expected. And I know you have a counter to that already. So over to you.
Yeah, Ira, we were expecting a 20 basis points increase in reverse repo simply because the operative cost of liquidity absorption through different VRR, auctions, that has already gone up to 380. So 335 going up to 355 wouldn't have made a difference, and we thought maybe RBI will take that, kind of chance of increasing it. They haven't done it, but I would read between the lines, and what basically, they're saying is that from 1st January they're going to move, mainly the liquidity absorption to, the auction-based route, which is basically the February 20 liquidity framework that was there before the pandemic. They want to move towards that, which basically means that once they've increased the 14-day VRR quantum to 7.5 trillion by the end of December, the 28-day also can move higher from the 50,000 crore. Then your liquidity absorption at the fixed rate, reverse repo, might fall below 1 trillion. And then the overnight call money rate can, slowly start inching towards that repo rate of 4%. So in my view, in short, RBI has delivered a stealth tightening without telling you so. You have to read between the lines, and I think things will be quite different when you hit January, and you'll see that all the short-term rates are already adjusting closer to the 4% mark. So whether reverse repo is at 335, it becomes completely meaningless.
Vivek, do you agree with that interpretation?
I would say completely, Ira. Our thoughts kind of mirror what Kaushik just said. The whole premise for us calling for a 20 basis point hike in December was that the groundwork was already done between the October policy and the December policy. The money market rates, which Kaushik just alluded to, had already started moving up. In fact, the VRRR auctions were getting somewhere fixed around 3.95, 3.96, almost kissing the repo rate. So in our sense, a reverse repo move in December policy would have been largely a symbolic move. It was just catching up to where the money market rates are currently. The fact that RBI has chosen not to do it probably tells you that they are giving much more importance to OMICRON risks at this point in time, despite sounding fairly confident on the growth recovery prospects, despite maybe raising a little bit of alarm on inflation, despite highlighting what other central banks are doing. I guess you had so many reasons to start the official commencement of the formal normalization process. You had just one reason to wait, and RBI chose that one reason to wait out. So hopefully, I guess we still have a little bit of uncertainty. If RBI is looking at uncertainty and this uncertainty continues to persist in February, then by the current logic, things will not be as clear as they are even now. So maybe we can be for a protracted period of uncertainty. However, if COVID were to be a risk which is somewhat more manageable, then RBI will completely go ahead with the normalization process.
So effectively, both of you are saying that the effective policy rate is now closer to the repo rate. So even if they move on reverse repo, February, wherever they decide to do it, it means absolutely nothing. Is that the point, Kaushik?
Yeah, so as Vivek mentioned, it's just playing catch up, right? I mean, if your rate is already at 380, now what is happening at the fixed rate reverse repo? Till now, we are absorbing 2.5 trillion, which is what the governor wanted by the December policy. Now he's saying that that 2.5 probably will be, coming down. Now he hasn't said whether it will be zero, and in the press conference they said it will not be zero, but it can be somewhere between 0 to 1 lakh crore, right? So because 1.5 trillion you are increasing for the 14-day VRR, so 2.5 should come down to 1 trillion, and the longer tenor VRR can be also increased from 50,000 crore to 1 trillion. So if that happens, then your absorption at the fixed rate reverse repo can come down to 50,000 crore. Not zero, but 50,000 crore. Then if you do a weighted average, 50,000 crore into 335 and the extra 10 trillion or 10.5 trillion at close to 4%, your weighted average cost is 395. So are you going to be concerned with whether reverse repo is at 335 when most of the bulk of the liquidity adjustment is happening at the 4% mark? So if everything is fine, if this Omicron scare goes away by February, you see headline numbers still coming down in India, then RBI probably will have to do a 40 basis points adjustment of reverse repo. At that point of time in February, just hiking 20 basis points will be again meaningless, right? I mean, if everything is quoting at 395, then you might as well bring the reverse repo at 375. Then you take a call, when do you want to increase the repo rate based on inflation and the longer term concerns and what the Fed is also supposed to do. From Deutsche Bank, we have a view that in mid-December, we expect Fed to increase their tapering, almost double it and end the tapering process by March, despite all these Omicron risks. And we have a lift-off for the Fed starting from June and 3 rate hikes in June itself. So if the Fed is going to hike 3 times in 2022 and finish their tapering by March, RBI has to move sometime in April, June.
So actually, by that logic, just the first part of your comment, Vivek, coming to you, then actually there's no point whether they hike the reverse repo or not. Then they should see, immediately move to the repo should they feel that there is an inflation risk. Because if your effective rate is anyway close to 4, what you do with reverse repo is largely irrelevant. If you start to worry about inflation, then you should move on repo.
Maybe that is what the idea is also, Ida, because the governor has on umpteen occasions highlighted this, that they would prefer a gradualist approach and they want things to get telegraphed very well. So not that the governor or the RBI actions have not been telegraphing their intent, because between October and December, what was happening in money markets was more of a signal or an intent from the RBI, which they did not, maybe because of Omicron reasons, follow it up in the December policy. So the intent is pretty clear with respect to what they want. They want the money market rates to nudge and in fact move towards repo rate. Now, whether they officially put the stamp of interest rate normalization, which is taking the reverse repo rate upwards, is possibly debatable at this point in time, given their preference for growth, prioritizing growth. So hopefully by February, they will be in a position, if Omicron is not a serious risk, to start looking at an official rate hike on the reverse repo front. So they will have to do it. I agree with you that it would largely be symbolic, but nevertheless, they will have to undertake that measure, because then it would signal the next leg of interest rate normalization, which is the repo rate.
Sorry to belabor this point, but I still don't understand what they're achieving with this stealth route or whatever we want to call it. Kaushik, the 10-year has already moved up to 640, right? Yesterday it was 639, today something 636 or 50 basis points down. It's gone up, over the last 2-3 months. The short-term rates have moved up as well. So if this is only that we don't want to use the word normalization, well, the market is already built in a fair amount of normalization. So who are they helping by doing it this way?
No, so using that logic, you would argue then what was the need for doing VRR in the first place, right? You could have just raised the reverse repo rate, but they chose to do, so what was the sequence of normalization? They first said that we'll start with 2 trillion VRR in January 21, when the liquidity surplus was 6 trillion, right? Then in April, they said 2021.
RRRs are a part of their stated new liquidity framework. So going to that was going to that framework.
Yeah. So the thing is, what you are asking in the previous question, if I get it correctly,
I'm asking that what is this reluctance to signal normalization and continue to do it via this stealth route? I mean, who are they helping?
So the thing is, that's why we expected 335 going up to 355 wouldn't have made any difference. You take the worst case scenario, suppose Omicron became an issue in the next 2-3 months and RBI had already increased reverse repo rate from 335 to 355. Then in February, we would assume RBI will not do anything. But your reverse repo then is at 355 and market interest rates are still possibly closer to that or higher. It wouldn't have made any difference. So they could have easily gone and done that. So to answer your question, I think, it's more of optics of not doing it at this stage. But, they might have to then, change it faster in February. If all the rates are moving up to 4%, then you can, keep it at 335, the reverse repo rate, but that will be a little, meaningless at that point of time. And then once it goes to 375, you can say that RBI can then again start thinking about the stance also. Do I need to keep the stance accommodative if the pre-pandemic level has been achieved? So this is more of an Omicron related optionality, if I may use the word, that RBI has bought, so that if they want to kind of delay the whole process of normalization from February, God forbid if we see more cases in January, February, then we have to reassess the whole situation. So RBI has decided, let's go slow, let's see the budget. We'll get more ideas about what is happening in the global external factors, oil and all these things. And then we'll take a call probably after the budget what to do, keeping in mind about FY23, whatever forecast they have given.
Vivek, coming to liquidity, the quantum. So, I mean, VRRRs, yes, again, they've said 14 days, and if required, they'll add the 28-day alongside that. But there again is no signal that they're looking at any sort of longer term absorption. Is that appropriate, again, given the sort of growth inflation mix that we are seeing? Because if they are signaling that they want an organic drawdown of this level of liquidity, we're looking at a 3-4 year process, depending on how currency in circulation grows.
So definitely. And just to recall, you also might have the problem of heavy debt flows, maybe in FY23, because if India were to get itself listed, then you'll have to start looking beyond the VRRR option. You will probably have to start considering maybe an NSF route, because that amount of liquidity cannot be absorbed directly by a VRRR. Even in the current context, Ira, the VRRR limit is not getting exhausted. While yes, you have a limit of 6.5, which will eventually go to 7.5 lakh crores by December end, and hopefully by January, you'll have the entire liquidity getting parked via the VRRR. But banks are not utilizing the 100% window which RBI is offering. So next year, or in fact, if you are looking at an organic reduction in liquidity, you will have to use a gamut of instruments. VRRR, our sense is that probably in that scenario will not be sufficient. Having said that, would RBI look at something beyond 14 days? Yes, definitely they should. They've started experimenting with the 28-day tenor. Maybe they can also start looking at slightly ahead, maybe 56 is something that they can look at. But our sense is that as of now, probably they would be reluctant going beyond the 3-month tenor. So they would, any experiment that they would probably do, any testing of waters they would do, they would keep it below the 3-month tenor. And that is where their focus would be, because the idea is to develop the term money segment, and their focus would be the 14-day to under 3-month segment.
Kaushik, I mean, we've been discussing this whole, the optionality, if we use your word, of MSS, SDF, everything is on the table. I don't know what will sort of, prompt them to pull the trigger on longer term absorption.
So, you're discussing basically the debate between the quantum and the price of liquidity.
Yes,
right?
so we've discussed the price, now we're talking quantum.
So my argument is, because it will be difficult to reduce the quantum, you at least need to adjust the price, which RBI has done the adjustment through market-related rates moving up without increasing the reverse repo rate. Now that might also play catch up and come closer to the actual operative rates in February or April. That's a discussion that we already had. As far as reducing the quantum of liquidity, one is obviously if the credit growth goes up, currency in circulation, those are organic ways of expecting liquidity to come down. Then, as Vivek mentioned, that in the budget, at least this next budget, we would expect market stabilization bonds to come in, at least to give RBI that optionality again. If they need, they can use it. In fact, we were expecting it in the February 2021 budget, and we are surprised that we didn't get that. Maybe next time around, we'll see some allocation being made for that. CRR, then what are the permanent things that you can do to reduce liquidity on a permanent basis, not just absorbing, just reducing? One is obviously a CRR hike. Now, can you do a CRR hike when credit growth is still uncertain? So you're ruling that out probably. Then you're talking about OMO sale. Now, OMO sale will obviously have negative consequences for longer tenor bonds. And, we have, government has already announced that they'll increase the expenditure, and we're not sure whether entire thing can be met out of the cash balances or whether there could be increased borrowing announced in February, March. So there will be a, risk premium on the longer tenor bonds anyway. So OMO sale you can rule out. So all you're left with probably Operation Twist to some extent, to manage the liquidity as well as not kind of add more to liquidity. But this is going to get more challenging as we go forward, because if you have more liquidity coming in April, June, what will happen? I mean, will RBI not buy dollars? Will rupee appreciate? Or if they buy dollars, you're again adding liquidity. So while you are normalizing, so that's why we thought that the normalization probably would be done more from a pricing point of view. And then the liquidity, as you said, will take a long time for that to come down to an acceptable level. This is too high. They're just absorbing it. A permanent reduction of liquidity will take a long time. Therefore, we would say adjustment of the price is required.
Let me just
I think to some extent, if I may add here, the cost angle will also get considered as to, let's say, liquidity is being managed. So who's managing that liquidity? Is it RBI who's doing it, or is it the government of India? So if the government of India is doing it via the MSS route, then they are obviously, paying a cost for it. Yeah. And if the RBI is doing it, they are paying interest on VRRR. So ultimately, who is bearing that cost? And which is the most economical way of doing it? Is it best if RBI bears that cost because it is cheaper? Is it best if government also pitches in because then it makes more sense? Our sense at the current juncture, it makes sense for the RBI to bear the cost because for the 14-day tenor, which RBI is actually subsidizing the market in terms of interest rate, interest income, the costs are fairly low. If the government were to pitch in from the MSS side, the cost for liquidity management will increase. Maybe this will become an option, a viable option next year when you have a deluge of inflows, possibly. So we are conjecturing at this point in time what kind of inflows can we expect next year. But if at all it were to happen, the government will probably have to pitch in.
That's an interesting point. A very quick word, Vivek, I'll stay with you and then move to growth and inflation. So it was fairly clear from Dr. Patra's comments that SDF is not something they seem like they're ready to use right now. I mean, it's been years since we've all been discussing it, but he was again very tentative on whether the tool is something they're ready to use right now or not.
Yes, it's not very clear because I believe the last discussion paper from RBI's side was a recommendation for the introduction of SDF. And the latest comments from RBI tells us that probably they're not very keen on deploying it at this point in time. And they also are in the camp of believing that as long as liquidity is being absorbed through market forces, through the auction route, that is something that they would prefer because ultimately they would also want the term money segment to develop. So I guess they're addressing two issues here, not just liquidity management, they're also trying to develop a market which did not exist. If let's say the reliance on SDF were to increase dominantly, then you will not have the opportunity to develop a term money market. So they are using both these objectives to fulfill both liquidity management as well as development of a term money, which SDF will not give you the opportunity.
Sure. Kaushik, just coming to growth and inflation, do their inflation projections match up with yours? Is there any element where you're saying they're underplaying some of the risks?
So we exactly have 5.3% for FY22, and actually we haven't changed that. Despite October and November inflation being on the higher side, you'll see the November inflation coming out. It will probably be around 5.3, 5.4, and then December the base effect starts becoming negative. So inflation could come closer to 6% in December, January. But remember, October, November inflation has gone up more than what people expected, is because vegetable prices went up. So every month, October, November, you got 2% month-on-month increase. So overall 4.5% month-on-month increase. These will all, kind of correct in December, January, just like it has gone up. So tomato prices hopefully will not stay at 100 rupees per kg forever, right? It will come back to 20. So it's a question of when will that adjustment take place, entirely in December or through December, January, February. So I think RBI has done a right thing of increasing the forecast for October, December from 4.5 to 5.1, while reducing it for the January, March a bit, because, if it has gone up in October, December, it should then, reduce. But that's the quarterly volatility we are talking about. Now, from a little medium-term point of view, in my assessment, after this COVID, India's baseline inflation expectation is 5 to 5.5%. We don't see the average coming down below 5%. If you take a 12-month kind of an average. So you are talking about inflation being 100, 150 basis points higher than the 4% target that RBI has. Now, as long as it doesn't go above 6% and stays over there, RBI should not be that concerned immediately. But also remember that the output gap is closing every quarter, right? It's negative, but it's closing. We are not at 2020 anymore. and will not have a lockdown like we had in 2020. So even in 2021, with that lockdown, RBI's growth forecast from 10.5 in February, which did not expect that severe second wave, has just come down to 9.5. So next year, the growth forecast of 7.5 or 8, which people have, might come down to 7%. Now, with 7% real GDP growth and close to 12% nominal GDP growth, 5 to 5.5% inflation, should the repo rate be at 4%? That's the debate that we should have. And I think we should be at least at 450 by the end of December 22, which will still keep real rates negative if your inflation is at 5.5%. So we think at least 50 basis points of repo rate hike is required in 2022, particularly if the Fed is going to increase to 25 basis points, if not 3 times, in 2022.
So you're building in continued negative real rates, which I think even J.R. Verma has argued is appropriate as the economy.
Yeah, so J.R. Verma was saying that real rates with respect to the repo rate, 4% is fine, but we are talking in terms of 335. And on growth, we have a forecast of 9.5%, same as RBI. April, June, RBI has given 17.2%. They have kept it unchanged because the April, June base is favorable. April, June 21, we could not grow to our potential because of the second wave. We are a little conservative with 14% growth in April, June, because I don't know what will happen, but I have taken a little bit conservative forecast. And we are getting a forecast of 7.5% for FY23, and compared to RBI's, compared to IMF's forecast of 8.5%. So we are conservatively forecasting 100 basis points lower than IMF, building in some kind of problems that can come up, which we don't know. So more or less in line with what RBI has given on inflation and growth.
Vivek, what's QuantEco Research's view on inflation? I know it's sort of a tricky territory to try and correlate what you hear anecdotally versus actual sort of projections. But it does certainly seem like companies talking about passing on input costs a little bit more, telecom tariffs being hiked. These are all potentially upside risks. I know the downside risk could emerge from vegetables, certainly, as Kaushik was saying.
Right. So we are a tad up in terms of our inflation projections vis-a-vis where RBI is. And we've been maintaining that forecast for the last 2 quarters. So for the year as a whole, we are at 5.6 vis-a-vis RBI's 5.3. And we think that risks are on the upside because, as you rightly said, you have telecom tariffs going up. That alone will impart about 25 basis points of upside to CPI inflation. That, in a sense, will completely negate the excise duty impact coming from petrol and diesel. And on top of that, you will have GST impact on certain categories of clothing and footwear, which will be effective from January of 2022. So in some sense, you're looking at a 40 basis points impact on CPI inflation upside, and you have about 25 basis points of downside impact coming from excise duty cut. So net, you are still looking at CPI inflation going up. And yes, there is some disinflation from global commodity prices, but global commodity prices have been extremely volatile in the last 2 weeks. So oil went down from 80 to 70, it is again back to 75. So a clear trajectory for global commodity prices is something that you cannot put a finger to it at this moment in time. But in terms of risk, we would expect it to be slightly on the upside. For the first half of next year, we would be broadly in agreement with RBI that inflation will come down from a level of, let's say, 5.6, 5.7 for Q3 and Q4 on an average basis to somewhere close to 5.1, 5.2, if not at 5% levels, which RBI is projecting. So maybe you can add a 10 to 30 basis points of upside vis-a-vis what RBI is projecting for the next 3 or 4 quarters of inflation. So nothing dramatically different.
Sorry.
Nothing dramatically different, but yes, risks on the upside.
Okay. I'll just close off the conversation with coming back to where we started. You sort of, in bits and pieces, both of you have answered that question. But Kaushik, so what is the path of sort of monetary policy from here on? What is the sequencing as you get into next?
So first of all, Ira, you should just watch RBI actions more on the auctions and the cutoff, and not just the statements, because RBI has actually done pretty well in normalizing. In the last 3-4 months, they've actually raised the cutoff rate, and they might sound more dovish while looking at the statements, and you have to read between the lines. But as far as actions are concerned, RBI is doing all the right things. Therefore, I was a little disappointed when I first heard reverse repo has not been increased. But when finally he said that from 1st January we'll move to auction, this is more or less in line. It's just about a few weeks here and there. So I would assume that if we do not get this Omicron scare and we are having below 10,000 per day cases, and it is still led by Kerala. So if you take that out, for rest of India is less than 4,000. These are very low numbers given the size of population, and we should not forget that India's vaccination rate for double doses has gone up to 51, 52%. Given the size of the population, this is extremely impressive. So this will again keep on increasing. Now the thing is, if everything is fine on the Omicron front, and even if Omicron spreads, but you feel that it is not deadly and it's just a normal flu, it might be a blessing in disguise that the nature of the disease changes completely with lesser hospitalization. Then if the short-term rates are already closer to 4%, then I think in February, there is no point of discussing 20 basis points or not. Whenever RBI has to adjust, they should do 40 basis points. So we are holding that view that assuming Omicron is okay, RBI should adjust 40 basis points in February, and then change the stance to neutral along with that in February itself. It might sound a bit aggressive now, but maybe in the next few weeks things could look a little bit different with the Fed becoming more hawkish. We'll see that. We'll see to that. Then we have a April 25 basis points repo rate hike, and then another repo rate hike in October 25 basis points, giving a lot of gap between April to October. Now, it might very well be the case that RBI does the reverse repo rate adjustment, 40 basis points in February, but still holding on to the accommodative stance. They take the opportunity of April being a big policy, particularly a big policy, the first policy of the next financial year, to change the stance to neutral, and then do the reverse repo, the repo rate increase in June, followed by another 25 in October. So big picture, we are still expecting 50 basis points reverse the repo rate increase, not more than that in calendar year 2022. Repo rate goes up to 4.5. It's just a question of which month. Base case is April and October, or at best, or if they push it back, it will be June and October.
Vivek, what's your sort of trajectory of normalization? And I'll throw in an additional question there as to whether, if they sort of roughly go along the route that Kaushik was detailing, non-disruptive for markets, for bond markets, pardon me?
Well, yes, it has to be non-disruptive because that is a clear indication from RBI. They've been saying it on and off, that it has to be well telegraphed. And our expectation is that if Omicron's virulence is something which is you can live with, and if the efficacy on the vaccine front is something which is not completely concerning, then February should be a live option for progressing on the formal bit of interest rate normalization via reverse repo. We believe probably RBI will resist from a complete 40 basis point move in one shot. Probably they'll break it into two parts between February and April, and then follow it up with repo hike. So as far as the quantum of hikes are concerned on the repo, we believe not more than 50 basis point is something that they would look at this point in time in the current year, in the next year. And as far as the international or the global surrounding is concerned, we also need to see that RBI is having a head start. While yes, there is a lot of talk on delayed normalization with RBI, with respect to RBI, but they have displayed a head start. They were the ones who started tapering their bond purchases before the Fed did. Yeah. They would probably start moving interest rates. If you were to consider reverse repo rate as the effective policy rate, then they would probably start moving the effective policy rate ahead of the Fed. So it's not that RBI is delaying vis-a-vis, let's say, the Federal Reserve. They are probably on track. It's just a matter of another maybe few months, as long as the pandemic situation is not completely concerning. So yes, 40 basis point of reverse repo hike if things are fine on the pandemic front between the Fed and April, followed by another 50 basis point of repo rate hike through the course of the year.
I'll leave it at that. Thank you both so much. Appreciate you taking the time to speak to us here on Bloomberg.
Thank you, Veera.
Thanks, Veera.
Always a pleasure.
Thanks for watching Bloomberg.